The one problem that I do find people come to me for help with is they use the do-it-yourself software. They've answered the questions the best they know how, but they don't necessarily know what the rules are. They don't necessarily know what's behind the question, what the question's getting at, and they don't necessarily even know whether it's done right.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
Hello and welcome to episode 61. Today, we have a very special episode on taxes because it's that time of the year. I've invited Duane Culver, the president of Culver CPA Group, to help us understand how tax laws can work in our favor, what we can write off and deduct, mistakes we should avoid, and tax strategies that we should keep in mind when it comes to real estate investing. Duane also teaches several courses for the RPOA on tax strategy, which I highly recommend. And we're lucky to have him here on the show today because it's his busiest time of the year.
That's right.
So Duane, thanks so much for taking the time to come talk to us.
You're welcome.
Now, why don't we just start with the basics? What are the tax advantages when you get into real estate investing? And why does it make sense from a tax standpoint to do so?
One of the advantages with real estate is even while the value is going up, increasing over time, we're able to depreciate and take tax deductions for our investment in that real estate while we continue to hold the real estate. So we get a tax benefit while we're holding an asset that's actually increasing in value.
So as it increases in value from a market standpoint, the government sees it as a property that's actually depreciating or decreasing in value because it's getting older.
Right, exactly.
And how are we, like, let's say we buy a single family rental. How would you typically be able to depreciate that? What formula would you use?
For residential real estate, the life is 27 and a half years. And the year you buy it, we use a mid-quarter convention. But just for planning purposes, if you took the cost of the property, we separate out the land value because that's land.
Land does not depreciate.
Right. Mm-hmm. Land does not depreciate. So we separate out the land, take the remaining portion that's for the house, and divide that by 27 and a half, and that would be your annual number.
Okay. Pretty simple formula. And commercial is a little different, right? If you buy a commercial multifamily?
Yes. Commercial is considered to have 39-year life.
Okay.
In any non-residential property.
All right. So that gives us an amount that we can depreciate every year. So, which basically, as we depreciate it, that is a write-off against the income we have from that property?
Yes.
And what other write-offs might we typically be able to look forward to in owning rental property?
Typically, when people invest, they're financing their investment. So the mortgage interest, property taxes, your insurance, any of your out-of-pocket costs in maintaining that investment would all be deducted.
Okay. So let's say, for example, we make $10,000 in cash flow on that property. We can avoid having to pay taxes on that $10,000 by deducting our depreciation,
right? By
deducting our interest payment. And what else did you say?
Property taxes.
So if we're paying $2,000 in property taxes, are we able to deduct that from our cash flow?
Yes, related. Mm-hmm. Yes.
Okay.
Insurance.
So your any of the expenses you take out of that cash flow.
Right.
Mm-hmm.
Yep.
Okay. Well, that's pretty powerful. That's a good way to make extra money.
Sure. We also, for people that do this regularly, may have some cell phone bills. They're using their car to get back and forth into managing that property. So some of their vehicle costs could be deductible. Occasionally, somebody may have a home office where they're managing these rentals from, and they may be able to take some deductions related to that home office. So there's some other areas, you might not do very much of that, if you have one or two rentals, but as there's more and more rentals, these costs become a greater portion. A greater portion of these costs could probably be allocated toward this activity.
Let's say, for example, you have spreadsheets that you put together and you go out and buy a laptop computer and Microsoft Excel and Word and everything. Is that something you can write off?
Yes, it should be prorated. What portion of this am I using it for personal use? What portion of the use is business use? And you deduct the business use portion.
Yeah. I've always found that to be one of the more powerful, tax benefits of owning real estate is you can take these things that end up, a laptop can be $1,000 or more,
right?
Depending on the prorated use of it. You can write quite a bit of that off against your income.
You could, yes. Mm-hmm. Yep. Yeah, if that's the purpose of it, and that's why you have it, and that's what you're using it for.
Absolutely.
Yep.
Tell us the type of real estate investors that you work with.
I work with a wide variety of investors. I own a single family, a two family in a commercial building myself. Have an IRA that owns a house. And for my clients, a wide variety of real estate investors, whether they own one or two rentals, a house or duplex, or some of them own dozens of them and, do this full time. Some manage property for other people. Some are real estate agents that also invest, just a wide variety of investors.
And you work quite a bit with the RPOA. You teach several classes on tax advantages and benefits.
Yes. I've been doing that for more than 10 years for them.
Okay, so you're well versed in the real estate world and how you can get tax advantages from that. And I kind of want to go through like the different categories: wholesalers, flippers, rehabbers, buy and hold investors, and just kind of talk about each one. And but before we do, I'd like to just kind of start with what are some of the common mistakes that you see real estate investors making when it comes to their taxes?
One of the things is when people are doing it themselves, sometimes they don't take the depreciation because they don't know how to do it, don't know how to set it up, or they do set it up and don't know the proper way to take depreciation, so they're taking the wrong amounts. So they should be taking depreciation. You don't want to not take it, because when you sell the property, you're going to be treated as if you had taken all of those deductions over the years, and it counts against you at the time you sell it. So you do want to take it as you go.
So even if you have not taken the depreciation during the time you've held the asset, you'll still have to pay the depreciation recapture when you sell?
Yes. We add back the depreciation that was allowed or allowable to have been taken. So it's important to take it as you go. Mm-hmm. There are some tools we can use to catch that up. If you've not taken it, we can help you correct that so you get those deductions. You don't lose them altogether, but it's not an automatic thing. You really should be taking it as you go.
Well, before we go on to other mistakes, let me just ask you, let's talk about depreciation recapture, because this is something that as you're getting into real estate, you're not even aware it exists. But you're depreciating the value of the building over the period of 27 and a half years, is it?
Right, yes.
Okay. And let's say you own it for 10 years and you sell. Well, you're going to have to pay back a portion of that depreciation that you were able to write off. What is that, the formula that's used? Like how do you... in other words, how much of that depreciation that you've been able to write off over the 10 years will you have to pay back?
We'd count it back as income. So let's say you bought the house for $100,000 and you were taking, off the top of my head, don't know what the number ought to be, but let's say it was $3,000 a year that you were taking in depreciation and you owned it for 10 years. So you would have taken your original cost of $100,000. We've taken $30,000 worth of deductions. So now our basis or tax cost in this property is $70,000. Now, if I sell this property for $150,000, I'm going to subtract my cost of 70, even though I originally paid 100. For tax purposes, my cost is 70, and so my swing from 70,000 up to the 150 sale price, that $80,000 is my gain. The gain, often we think of it as a long-term capital gain because we held the property for more than a year, and long-term capital gain is good because it's a lower tax rate than our ordinary tax rate. But 30,000 of that gain came from depreciation deductions that we took at our ordinary tax rate. So that $30,000 is added back at our ordinary tax rate, but not more than 25%. So there's a cap on it. And the remaining $50,000 worth of gain is at the long-term capital gain rate.
Okay.
So it's added back to our income, just as we took a deduction as we went. When you sell and get the cash out, at that point, it's picked back up as income.
Let me repeat that and make sure I understand, because I'm sure
that's
there's
okay.
people's heads are spinning right now, and I want to make sure it's clear. You buy a property for $100,000. Over a 10-year period, you get $3,000 a year in depreciation that you can write off against your expenses. So after a 10-year period, you've basically written off about $30,000 in depreciation.
Right.
Now the basis, and that's a key word there, the basis, which is the for tax purposes, the value of the property.
Is your cost.
Your cost has gone down from $100,000 that you originally paid to $70,000 because you've depreciated $30,000 of that.
Yes.
Am I on the right track so
yes.
far?
Yeah.
Okay. So if you sell for $150,000, the IRS is going to look at, okay, $50,000 of that. You paid $100,000 originally, so that $50,000 profit is taxed at long-term capital gains. But there's that $30,000 between the basis of value, which is at $70,000 now, 10 years later, and the $100,000 you originally paid. How is that taxed again?
That's taxed as ordinary income, so your ordinary tax rate, but there's a cap. If your ordinary tax rate is more than 25%, it will not be taxed above the 25% tax rate. If your ordinary tax rate is at 15% or 25%, it'll be your ordinary rate, whatever it is.
Okay, so let's say you don't have a job and you sell, and you don't really have any other income. So your tax rate might be very, very low, and you might only have to pay 15% on that $30,000.
Right. Yeah.
But if you have a job and you're making $200,000 a year or more, then you're going to be at a higher tax rate. So you may have to pay up to like 30, over 34%.
Yes. The tax rates are, almost 40%.
Yeah, up to 40%.
So,
okay.
But it's capped. This recapture is limited to 25%. It would never go above that.
25% of
tax rate.
The tax rate.
So
it's not you're not taxed on 25% of that $30,000. You take
the tax rate applied would never be more than 25% on that $30,000. So it could be.
So let's say
it could be taxed if your ordinary tax rate based on your income is usually 15%. That $30,000 would also be at 15%. Unless, of course, in the year of sale, it's going to push your income up higher. So we would count your other income first, and then we would look at this $30,000, and part of it might be at 15%, but part of it might push you up into the next tax bracket. So a portion of it might be taxed at 25%. But after that gain is counted, then we look at your long-term capital gains and apply those rates to that income over and above.
Okay, so let's just say it's taxed at 25%. You're being taxed 25% of $30,000.
Right.
So we're looking at what?
$7,500.
$7,500. Is that what you would pay in taxes, or are you saying
that would be the tax on that portion
on
of
that
income?
Portion.
Yes.
Okay. All right. That helps. And if you're listening to this and your head's spinning, this is why I always recommend you get a real CPA to do your taxes, because and that's what you are. You are a real
Yes.
CPA, because even though I've been doing this for years, I still haven't quite wrapped my head around all the tax ins and outs of owning real estate.
Sure, there's a lot of details.
What have you seen out there that someone comes to you and says, "Oh, maybe I should have you help me with my taxes, and here's what I've been doing."
Right.
What kind of mistakes do you usually see that they've made?
Yeah, people don't always know what they can deduct, what they cannot deduct. They'll miss maybe counting some of the mileage that they could count toward taking care of that rental property. They might they might forget to take deductions for insurance they've paid or something like that. Sometimes I have, when people give me the information, they count as their expenses their whole mortgage payment, which includes principal, which the principal portion is a loan repayment, and that's not a tax deduction.
It's not an expense at all, because you're basically just repaying the loan.
Right. There's a lot of details, nuances to it. So, people don't understand that they just need help and some guidance sorting it out.
Have you ever had someone come to you and they've owned rental property and they've been doing it themselves, and they say, "Okay, I want you to take this over," but you look at it and it's such a mess that you don't even know where to begin?
I've seen that. We'll take the information they have and help figure out this year's activity, what should be income, what's deductions, do our best to help them get the information they need so we can take depreciation and get that set up and in order. It's even more challenging when they have a partnership that's been owned real estate and they've not done things well or completely.
So if there's another investor or other investors involved.
Right. And, maybe they're not maintaining a balance sheet. When we do our personal returns, usually we don't report a balance sheet. Partnership returns or corporate returns, there's a place to report a balance sheet, which by itself doesn't change our taxes, but it creates a measuring stick for us to measure from the change from one year to the next. And we know whether we have everything. We know whether or not we've reported the income and expenses correctly because we have this measuring stick included. So when somebody brings us a return and that work's not been being done, it creates a little extra challenge to help get that established so that going forward, we have that measuring stick in there every year.
So the idea of a balance sheet, that's a concept that I will bet you a lot of investors listening to this right now don't even know what you're talking about.
Okay.
So talk about what is a balance sheet?
A balance sheet, we balance our assets, the things that we own, with our liabilities, the things that we owe, and our net worth. So our total assets, if we subtract the liabilities from that would give us our net worth in that business. So our liabilities plus net worth should be in balance or equal to our total assets. And that's where we get the term balance sheet, is we're trying to balance these two sides to the page.
And that would include things like capital improvements that you've put in.
Yes.
And the mortgage that's outstanding, the value of the property when you first purchased it. If you are an investor and you're doing your own books, but you don't have a balance sheet, what kind of trouble can you get into? I'm
not sure that you necessarily get into a lot of trouble. What's difficult is you don't really have a way to measure, am I moving forward or am I moving backwards, and by how much? Having the balance sheet helps you adjust your financial position. So you'll have a list of what you own and have a number. You'll have a list of what your debts are, have a number, and your net worth. And ultimately, as investors, we like to see that net worth growing every year. And the balance sheet is a tool to demonstrate, here's where I was, here's the progress I've made. One of the challenges with real estate is it's a long-term game, usually. So, yes, there's some business activities where we flip houses or do some wholesaling and make our money in a short period of time. But most real estate investors are in it for the long haul. And during that long haul, especially in the early years, if you financed that investment, you're not seeing a lot of return because what money you make, you're paying out in mortgage payments and trying to pay off these debts. And the balance sheet can help you see the progress that I'm reducing the debt and I'm increasing my net worth. And so it gives you that measuring stick so you can see the progress that you're making each year and see if you're reaching the milestones that you set for yourself.
Now, at a minimum, if you're doing your own books and you're keeping your own records as a real estate investor, what software should you be using and what types of statements should you be preparing every month?
QuickBooks is really widely used in the marketplace. They have big market share. They have the desktop version. There's online versions. They're not the only software out there. There's other good ones out there. Xero, Xero, is a online software a lot like QuickBooks. For my personal use, I use Quicken, which was the first product that Intuit created before they created QuickBooks. It's kind of the home version.
Will Quicken give you a balance sheet and help
Quicken
you with real estate?
Quicken can. They don't call it a balance sheet. That's more a business term, but they can give you that type of report. And then, so you'd want a report that looked like a balance sheet, and then a profit and loss statement. So it shows your income and your expenses for the month or for the year. And particularly in working with real estate, QuickBooks or Quicken has what they call a class. Other software might call it a department or, another way to subdivide the information. That way, I don't have to have a separate income account for each of my 30 different rental properties or however many I might have. I can have one income account for rent income, and then I have a separate code that identifies which property. And in Quicken or QuickBooks, they call that feature a class. So I'll set up a class for each property, and then I can pull a report that shows me income and expense for just that property, or I can pull a report for income and expenses and have a column for each property.
Well, let's get into some of the specific types of real estate investing and what, as these investors who don't have you as their CPA or some other reputable CPA company doing their taxes, if they're trying to do it themselves, what they should be thinking of. And I'd like to just start with wholesalers. We've talked to a lot of wholesalers, especially at the conference last week. A lot of people are doing this now. What do they have to look forward to during this tax season as they fill out their tax paperwork?
Wholesaling is not really an investment activity. We define investment as, I guess if you think about, we know that buying stock is an investing activity. So what are the purposes for which you would buy stock? You're either looking for dividends, so recurring income to come from that stock, or you're looking for long-term growth in the value, looking for appreciation. And that's how they define what is an investment. So an investment activity is treated one way for tax purposes, and business activities are subject to different rules. So most of the time when you're buying rental property, that's an investment. But if somebody's wholesaling or flipping, that's considered a business activity. so the business rules apply instead of the investing rules. So a business activity, you would report that on a Schedule C in your individual tax return instead of Schedule E, which is what we report the rental activity on. And we report all of the income. If it's a business activity, all the income's reportable in that year you earn it, even if it was a contract that pays over 2 or 3 or more years. Usually it's income, earned right up front. And as a business, you're subject to self-employment taxes, which is Social Security tax that's added to your income tax. And that catches a lot of people by surprise that haven't done their homework on a business activity, or even understanding that the type of real estate that I'm involved in is a business versus an investment. Some people think that all real estate is an investment, and that's not necessarily true.
Yeah. So if I'm wholesaling and I'm not even taking possession of the property, I'm getting a property under contract and then assigning that contract to another buyer, but taking, $5,000, $10,000, $15,000 as for my part of that transaction, that's considered business income.
Yes.
And as business income, it's subject to Social Security tax, self-employment tax.
Self-employment tax is the Social Security tax.
So not only then am I paying tax at my, what rate am I paying the tax on that profit?
So you're going to pay your regular income tax at your ordinary tax rate, whichever bracket that brings you to, and we'll add to that tax the self-employment tax, which works out to be a little over 14%.
An additional 14%?
Yes.
On top of your regular income bracket?
Now, Social Security does have caps on how much is subject to Social Security tax. And once you've hit that limit, it would drop to a lower rate, just paying the Medicare portion of that, which would drop it down to a little under 3%. But until you've hit that Social Security maximum for the year, it works out to be just over 14%. Yep.
Wow. So that's a big bite right there.
It is.
Is there a way for a wholesaler to change the way that income is viewed by maybe starting a business of some sort, or are they just going to have to pay that?
We work with a lot of small businesses, and often a small business will set up as an S corporation. And the S corporation doesn't pay, the profits of the S corporation are not subject to the self-employment tax. So an S corporation doesn't pay its own taxes. It's very similar to a partnership in the way that it's taxed. So it files a separate tax return, but it doesn't pay its own tax. Instead, it identifies who the owners are and what each owner's share of that profit is. And then the owners report that income on their personal returns. And with an S corporation, you can have just one owner. So often a sole proprietor, once he gets to the place where he is making enough income to justify paying himself a reasonable wage out of the company, and we're filing payroll reports and those kinds of things to deal with the fact that he's paying himself wages, but he's required to pay himself a reasonable wage if he's taking money out of the company for the services that he's doing. After he's paid himself a reasonable wage, any profits that are left over, he's also reporting on his personal return, but those profits are not subject to the Social Security tax. He's paid Social Security tax on his wages, but not on the remaining profit. So that's a tool we can use to control how much tax we're paying. I always want to point out to people that consider an S corporation, and if they're not paying themselves in wages as much as they should be paying themselves as much in wages as they would be earning anywhere else. But one of the things I would like to point out is Social Security is the one type of tax that we pay for which we get benefits somewhat in proportion to what we put into the system.
Eventually.
The more we pay in, the greater the potential benefit. Whereas most other types of tax we pay, we get the same government benefits and services, whether we pay a small amount or a large amount, it doesn't matter. We drive on the same street. But, Social Security tax, the benefit is based on the amount that you've put in.
Right. So, however, if you're in your 20s and you're thinking about your retirement and how that you'll recoup that Social Security payment, a lot of people in their 20s believe, well, it's not even going to be there for them at that point.
That's true. And so I encourage people, if we're using an S corporation to help you reduce how much you're paying in overall tax, let's make sure that we're taking that savings and investing it in planning for retirement. And would an S corp allow you to set up your own kind of IRA fund? You could set up a SEP plan, a simple plan, a 401k plan. A number of different tools would be available to you.
So you can direct it to your own retirement and direct the use of those funds as opposed to directing it into a Social Security fund.
Right.
Great. So a savvy wholesaler would confer with their CPA and decide, should I set up an S corporation in order to help, reduce my tax liability?
Yes.
Great. And what about flippers and rehabbers? Because they are a flipper or rehabber, they are taking possession of the property. They're holding it for a period of time. They're improving it and then selling it. Are they also looked at as a business as opposed to an investor?
They would be, yes. And so similar rules would apply and similar strategies could apply in trying to control how much tax they pay.
Mm-hmm. So do you often recommend the same sort of setup, an S corporation for flippers and rehabbers?
Yes. Yep.
Mm-hmm. What about the rehab portion? Are there ways to maximize your deductions through the rehabbing process? Because you're putting a lot of money into some of these properties.
You are. And one of the things we try to do, and that's another thing people don't understand, is all of those costs really are adding to your investment in the house, and you're not going to take any deductions until you sell the house. So we track your mileage costs. We track the insurance and the interest that you've paid on financing the arrangement. And all of these costs add to your investment in that property. And when you sell the property is when we take most of those deductions. And depending on how much of this business you do, sometimes we can take some of those deductions sooner. It's going to depend on the business and how it's set up and how much activity there's there. But especially if somebody's just getting started and they only have one deal that they're doing, they might be incurring all of these costs in 1 year and they don't sell the property till the next calendar year. We would hate to have all of the costs show up here as a deduction and no income to take against it. And then in a later year, have all of this income with high tax rates and
So
applied.
Are you able to defer your deductions? So you're saying basically
Yes.
defer those deductions until you sell the property?
Generally, that's the approach. If you have multiple deals going on at once, there's a position we can take where some of these are ongoing business activities, not necessarily related to a particular deal, and we would, some of the marketing costs and so forth, we would take deductions as this is how the business works, and that we take marketing deductions. But if you're doing one deal at a time and you're not marketing that house until it's finished, we'd want to apply those marketing costs against that house when it's sold.
Sure. And is there any tax liability if you buy a house and you're rehabbing it, but you haven't sold it yet? There wouldn't be any tax liability in the first year.
No,
would there?
No, it would show up when you sell it.
Only when you sell.
Right.
The tax form that you would fill out if you're a wholesaler or a flipper, rehabber, which I know you said it before, but what tax form should they be
We'd use a
out?
Schedule C.
Schedule C.
Yes, unless they set up an LLC or a corporation and elected with either of those to be treated as if they were an S corporation. At that point, the S corporation would be filing a separate tax return.
So the S corp files a separate tax return, even if it's a single member.
Yes.
S corp.
Yep.
Okay.
Yep.
And that separate tax return, is there a name for that?
1120S.
1120S.
Yes.
See, at this point, I'd say forget it. I'm gonna just hire Duane to come do my taxes because too many numbers. Well, let's talk about some other investment strategies. If you're a buy and hold investor, you buy a single family or you're buying some multifamily, what do you have to look forward to at tax season?
Usually we report each rental as a separate activity on Schedule E. So there's multiple. Schedule E has a place for 3 separate rentals. And if you have more than that, we attach additional copies of the form.
So you'd fill out your own personal tax form, and then you'd add a Schedule E.
Yes.
For the properties where you list your income and your expenses and everything.
Right, for each property. And we track each one separately because losses are generally not allowed. Depending on your income, you might be allowed some losses from rental activity if you are the one that's actively managing them. If you have a separate manager, losses would not be allowed, except to the extent that you have other rentals that have income. So we track each property separately to track these income and losses, because if the loss is not allowed, it carries forward to a future year. And if you have several years, and with depreciation, often they do show losses until they're paid for and you don't have mortgage interest anymore. So the rentals often show losses, and these losses will carry forward into a year where there's income. But if you sell the property before there's income, then we'll go ahead and deduct the losses at that point in time. So we track each property separately. You would be allowed to pool them all together if you wanted to. But then you can't deduct your losses from any of the property in that pool until you've disposed of the last property in the pool. So for that reason, we report each property separately and track those expenses.
So let me make sure I have this straight. So if I have, let's say, a single family and a duplex and a triplex, I can write off the expenses and the deductions from my single family only against the income from my single family. Right.
So we're going to take, show the income, we'll show the expenses, we'll come up with a net profit or net loss for that property. And we'll do the same thing for each of the properties. And if there's income on one, then we'll allow losses from the others up to that amount. And, and end up at 0 in total for the return. To the extent that you've had losses from some of these that are not allowed because the other rentals don't show enough income, those losses are carried forward to the next year to see if there might be income on that property for the next year. And if not that property, are there other properties that show income that, we can use to offset those losses? So yes, we look at it first by property, but then we also will look at in aggregate, am I allowed some of these deductions?
So if I have a single family, a duplex, and a triplex. Let's say I've had that single family and my income is still higher than my losses, my deductions. I'm showing a little bit of income. I could take some of the deductions from my other properties and apply it against that income, or is that,
yes,
so
the net profit or loss, yes.
Mm-hmm. Okay.
But overall, when I put everything together, I'm not allowed a loss. I'm only allowed a loss for rental property if I'm an active manager, investor, actively involved in these properties, and if my income is less than $100,000. If those two are true, I'm allowed up to $25,000 in losses in a given year. That $25,000 is phased out as my income increases from $100,000 to $150,000. So once my income is $150,000, I'm allowed no losses from rental activities. All of this whole set of rules does not apply to real estate professionals. That's probably a topic for a different time.
Yeah.
But generally for most people, these are the rules that we work with.
So is there a scenario then in which I can't write off any of my losses on my properties because I'm not managing my properties? So I don't manage my own properties. Say I have a 4-unit where I'm writing off the mortgage and the depreciation on that 4-unit, right?
Right.
Depending on how long I've owned it, I may not have to pay any tax on the income from that particular property because I have enough deductions.
Right.
And is that allowed even though I'm not managing the property?
So, yes. So it's a 4-unit and maybe it brings in $50,000 in rents a year, and you have management fees that you're deducting and property taxes, mortgage interest, depreciation. There's going to be maintenance costs related to that. And if you end up with a loss, say you end up with a $10,000 loss for the year on that unit, then that loss would not be deductible, if your income's over $150,000.
So I can't deduct it from my job income.
Right. It cannot offset that.
It can only offset the income from that particular property.
Right. It would carry forward. And I find myself in that situation because I have somebody else manage my property as well. Maybe I should back up. I don't know that I made this clear. If you manage your own property, you could deduct that loss if your income was below $100,000, or if you fell in that phase-out range between $100,000 and $150,000.
I could deduct that loss from other income.
Yes.
Not associated with that particular property, but maybe from my W-2 income or from income from other properties.
Yes.
If I make under $100,000.
Yes. Mm-hmm. And that ability phases out between $100,000 and $150,000. And above that, you would not be able to deduct losses except to offset income. If my income's below $100,000, but I've still hired a manager, somebody else to manage my property, I'm not the person primarily involved with managing the property and taking care of it, then I'm not considered to be active related to that business. And I follow the same rules then as somebody whose income is above $150,000. So even though my income is below $100,000, I'm not able to take deductions related to for losses, not able to deduct overall loss on a property because I'm not actively involved in that business.
Okay, so let's take my single family as an example. I have my expense, I have my income, I have my expenses, and then I have my depreciation and whatever other deductions I would have on that single family. If the expenses and deductions exceed my income, that's the loss. That gets applied to future years.
Right.
Or when I sell the property. I can't apply that loss to offset any of my income anywhere else, whether it be from my job or any other property.
Other property would be allowed, but not from a job or from interest income or...
Okay, so I can apply it against income from other properties.
Yes.
And you're not saying that even though I've hired a third-party management company and my income exceeds $150,000, I still can't, or I can still deduct and have expenses that offset my income for the properties.
Yes.
That's still allowed.
Right.
It's just I can't use those losses to offset other income.
Yes.
Okay.
Exactly.
Okay. Yeah, that's a confusing thing to kind of get your head around.
It is. So for that reason, we don't because we need to track these and we want to be able to take the deductions as soon as we can, if you sell a particular property and there are losses associated with that property that have not been able to be deducted in the past, we want to make sure that we can deduct them in the year of sale. And if that property was pooled with other properties, we're not going to be able to take those losses until the year that we sell the last property in that pool. So generally we report each property separately.
Yeah, that seems cleaner that way.
It's cleaner. But if you have somebody with 40, 50, 60 properties, it's a thick tax return.
What about people who are landlords or property managers themselves? What are some of the things that they should consider?
I would think of the landlord as the real estate investor that we just talked about. Typically, in my mind, that'd be synonymous.
Mm-hmm. So they're an active participant.
Yes.
In the real estate investing, which gives them a little bit more leeway to deduct.
That's true. They'd be the active participant versus the investor that had somebody else managing their property. Mm-hmm. Somebody that manages property for somebody else, that would be a business activity. So they're not collecting, the rents they collect are not their rents. So that, they need to act in a professional manner and provide reports for the people they're managing property for. But the management fees that they get and their expenses related to running that business, they'll have a lot of mileage and probably some office supplies and expenses and various things running this business. All of those costs would be a deduction. But that would be a business activity. Mm-hmm. Reported on Schedule C, again, subject to both income tax and self-employment tax.
What if you sell something on a land contract? If you own a property and you sell it on a land contract, what do you have to look forward to at tax time?
For somebody that's invested property and has a large gain in that property, a land contract's a very nice way to report that gain over a period of years instead of paying the taxes on the gain all at once. If you are a dealer, somebody flipping houses, this option is not available to you. You can still sell on land contract, but the gain is going to be taxed in the year of sale. For an investor that's owned the property, though, for a long time, probably has a large gain built up in there. If they sell on land contract, we take their sale price and we calculate what portion of that sale price is a gain. So it could be nearly 100%. It could be 80%, maybe, depending on how long they've held that property, and maybe it's fully depreciated. So, it could be nearly 100%, but in our example, we'll say it's 80%. So if they sold the property for $200,000 and 160 of that 200 is gain, that's an 80% figure. We'll only report the gain on their tax return as they collect the money. So to the extent that they got a down payment, if they got $20,000 down and no other payments in that first year, we would have $20,000 times 80%, be $16,000. That's the amount of gain they would report on that first year's tax return. The rest of the gain they would delay until they start collecting those principal payments. The interest will be income as well, as they get paid, collect principal and interest. They'll have interest income. But if they get $20,000 in principal payments the second year, the gain that they'll report on the second year's return would be another $16,000.
So they'd be paying taxes on the $16,000 portion,
right?
Whatever their tax rate is. And what is that tax rate? Is it their regular tax rate, or is it a long term?
It's going to follow under the same rules we talked about earlier. So part of it could be a recapture of the depreciation they took, and we count that first. So if, in this example, it was $30,000 in depreciation that they'd taken over the years, in the first year they reported $16,000 of gain, that $16,000 would all fall into that depreciation, we call it Section 1250 gain, taxed at their ordinary rate. The second year, they'd have another $14,000 remaining, and $2,000 would be taxed at the capital gain rate. And then as they collect the rest of the principal payments, the remaining payments would all be taxed at the capital gain rate.
Wow, so that's a pretty complex formula that you have to follow.
And keeping track of it, keeping records of it. Mm-hmm. But it's nice because you're not pushing yourself into a high tax bracket, even though capital gains are discounted tax rates. My capital gain rates vary as well, depending on the amount of my income. And if I had all of that income in one year, I might be paying more in tax. I probably am paying more in tax on that capital gain than I need to if I can spread that gain out over a period of years.
So if you spread it out over installment payments, then you can kind of control the tax bracket you're going to be in as far as that income that's coming in.
Until your buyer pays you off.
Yeah. Now, if you've owned the property for a while and you sell it on a land contract, the depreciation recapture, when is that due? Is that spread out as well, or is that due upon sale?
That's going to be spread out. For real estate, generally, there's a small window of time if you bought property in the early 80s, that might fall under a different code section. Very accelerated depreciation methods we used during that time. And I say we as if I did work at that time. I started doing work in the late 80s, so a lot of these rules changed in 86. So if you have been investing for that long and have property, for that length of time, there may be some different rules. But after that time, all of your depreciation, you don't have to recapture that and pay that like in the year of sale. That is true for a business that sells equipment and sells, other things. When they sell, even on an installment sale, that recapture shows up in the year of sale, even if they didn't get any money. But that's not true with real estate generally, unless it falls in those.
If I'm working with a seller who owns their property free and clear, and we're going to do an installment sale, a land contract, they don't need to be concerned about repaying their depreciation recapture in the year that we sell it. That can be spread out over the period of years along with the terms of the land contract.
Right.
What about not just tax planning, but retirement planning? Can you talk about how the two work together, the tax planning with the retirement planning?
Yeah, it's interesting. Tax time is the only time that you're upset that you made money. You go see your accountant and you're mad that you actually had a good year or so forth. And it's also an interesting time when you're wishing you'd been disciplined during the year to put more money into a retirement account. And during the year, you're thinking of all the other things you could be doing with that money. One of the things with real estate related to IRAs is a lot of times people can take a 401k or their real estate accounts and roll them over into a self-directed IRA account. And that self-directed IRA account can invest in real estate. It can buy a house or buy property. And that property, generally, you're not filing a tax return. You're not reporting the income. If it's a traditional IRA, the only time that IRA is going to pay taxes, well, the IRA doesn't generally pay taxes. You'll pay taxes on that IRA when you take the money out, just like any other type of investment you typically would buy with that IRA. A Roth IRA has the advantage that you didn't get the tax deduction up front, but all of the earnings from that IRA generally are tax-free. when you take the money out in your retirement years. That's a really nice tool, and it can work for real estate as well. So the exception to an IRA paying tax, an IRA could pay tax, is if there's business activity in the IRA. So if the IRA actually was flipping houses or another type of business activity, it could be required to pay what we call unrelated business income tax. Most people don't ever get into that type of situation. One situation for rental property, rentals are not considered a business activity usually, is it could be subject to tax if it was debt financed. But normally,
so if you have a mortgage on the property.
Yes. But that's difficult to set up too, because for an IRA, the IRA is allowed to borrow money, but you as the owner of the IRA are not allowed to guarantee that loan. So that limits your ability. Typically, you're buying property with money from the IRA, and you're not borrowing money typically.
So a bank would traditionally want recourse financing. They want to be able to have you personally guarantee the loan.
Yes.
If you buy it through a self-directed IRA, they're prohibited from doing so, which means you're probably not going to get a bank loan in your self-directed IRA.
And there are cases where banks will do that. They will work with you, but they're not going to finance 100%. They might finance 50%. So that would give you some leverage. But the downside is now that IRA account needs to file a tax return and pay that unrelated business income tax. So most people try to avoid this if they can. So it's a great tool, investing in the IRA. I think real estate is a great investment. And I think IRAs, and particularly Roth IRAs, are tremendous tools in the long run. And there is a way to put them both together and use that IRA to buy real estate. But typically, most of the time, you're going to be buying the real estate without borrowing any of the money. And so that limits your ability to grow and how quickly you can invest in the real estate.
So, you see a lot of tax returns, and you've been doing this for a while. What's your thoughts on real estate as just a way to create wealth? Yeah,
you took use the words I would use. I think real estate is a great tool for building wealth because the pricing of it is much more stable than what you're ever going to find in the stock market. It jumps around and there's a question of how do you measure the underlying value of stock when, it fluctuates so much. With real estate, yes, we have seen times when it loses value. Traditionally, it's pretty stable. It increases usually at a measured rate. It's a good tool to be able to use some leverage, borrow some money. So with a fairly small investment, now you're leveraging a much larger investment and doing so in a relatively secure setting because you're not worried that investment's going to suddenly lose half of its value.
So you like it?
I like it. I've used it and recommend it, yes.
What advice do you have for those who are at home listening to this right now that are thinking, darn, I got to go get my taxes going? What software do you recommend?
Yeah, and we talked about that a little bit with QuickBooks or Quicken.
What about TurboTax or filling out your tax?
Yeah,
forms?
I'm not familiar with the do-it-yourself programs. The one problem that I do find people come to me for help with when they're being audited is they used the I want to call it self-help. I don't know what
the TurboTax.
Yeah, the TurboTax or whatever it is. And they've gone through, they've answered the questions. They answer the questions the best they know how. But they don't necessarily know what the rules are. They don't necessarily know what's behind the question and what the question's getting at. When they're done with the return, to look at it, they don't necessarily even know whether it's done right. By looking at the tax return and reading through it, they're not necessarily in a position to know whether everything's in the right place. I've had clients deduct things twice. Ultimately, they're audited because they've taken the deductions in two different places, and one of them's inappropriate. They get audited. So I do their work now.
At what point should someone come to you?
I recommend getting professional help if when you are finished with the return and you read through it, if you don't understand what you're looking at, can't tell if it's right, maybe you should have somebody that can tell whether or not it's right, read through it with you or for you.
Yeah, and I would answer my own question by saying if you're going to take real estate seriously as a business, then you need to get a good CPA on your team.
And answer your questions, get advice, and what are the best ways to set up your business and your transactions and best ways to do what you're doing.
Right from the beginning, way before you ever get to the tax return.
Sure.
Just setting up your business is an important thing.
Yep.
Yeah. Yep. And getting a good CPA to kind of help advise you on how to set it up properly, that's invaluable. So, Duane, I know it's the middle of tax season and you're very busy, but if someone did want to get a hold of you, because this is going to come out next Monday, because I want to rush it out there for our listeners as they prepare their taxes. If someone does want to talk to you, what first of all, are you available? And do you want them to get in touch, or how should they get in touch with you?
We'd be happy to help people do their taxes. The best thing to do to reach me is to call my office at 616-456-6464. And they could also email me at dculver, that's CULVER, at culvercpagroup.com.
And are you, this podcast, people listen to it all over the country, all over the world. Are you focused mainly on people here in Michigan, Grand Rapids, or do you have clients all over the country? I
can help clients all over the country. That's not a problem. I have a few clients overseas who have invested in the U.S. and need a U.S. return completed, and we can help them do that too.
Okay, so you're there for everybody.
I try to be. Yeah.
Excellent. And your website, why don't you say that as well?
Yeah, culvercpagroup.com.
Culver, CULVER, CPAgroup.com.
Yes.
Great. Well, Duane, thanks so much for taking the time to talk to us. As people sit down to do their taxes, and if they've already done their taxes by the time they hear this, then they probably don't need our help. But I would imagine quite a few real estate investors are put it off as long as possible. So hopefully this is helpful, and thank you so much for having the conversation.
Thank you, Brian. It's been fun.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.